Good afternoon from the Shreveport office of Eagle Financial Management Services for the latest edition of the Jack and Bill Show. We missed last week. I happened to be out of town. No, I was here Friday. We wound up just missing a week. It's been a roller coaster the last 3 weeks. We're going to talk about that some today. But the S&P 500 for the month of September, we were right around all-time highs, up about 21% when we started the month on a total return basis. We closed yesterday up 19.7%, went up 6 points today, or call that 15 basis points, 15/100%. So we're flirting with right there at that 20% year-to-date number, which is twice the historical norm of the U.S. Stock market. So the bond market's a different story, and it has gyrated all over the place. The Barclays Aggregate Index down 3.3% in the first 3 months of the year, rallying back some, and so year to date the bond market is flat to down just a smidgen. A very popular large bond fund that we watch, the Dodge and Cox Income Fund, tipped back negative to down 0.1%, and I think it will close down today, as we've seen last couple of days a real steepening in the Treasuries bond market. That is the long end of the curve, the yields going up. Of course, the short end of the curve is pegged by Jerome Powell and our Federal Open Market Committee, our Federal Reserve, keeping the Fed funds rate at zero, likely till the end of next year. We had an FOMC meeting this week. Of course, we knew there wasn't going to be a decision to make on interest rates, but we're at 0.32 on the 2-year note, 1.45 on the 10-year, and back to 1.98, flirting with 2% on the 30. So the stock market was mixed today. NASDAQ down a smidgen, Russell 2000 small caps down a smidgen. Oil and nat gas have been a huge story with commodity inflation. West Texas Intermediate rising to just shy of $74 a barrel. That's getting noticeably painful at the gas pump, and nat gas prices hovering, right around $5. That's up 100% this year, Bill. So gold, the yellow metal, down $3 an ounce today, closing at 1,746. Or those markets haven't closed; they're actually still trading. So, but we had 2 weeks of a pretty good shakeup, downturns, and that's really related to this Chinese real estate company. How do you pronounce that? Do you know?
Evergrande.
Evergrande.
Good Chinese sounding name.
And that with basically there's 3 things, and I'm going to let you elaborate on this, Bill, to start us off. But we've got Evergrande really kind of kicked it off with the second largest real estate company in China defaulting on some of their bonds. Some of them they haven't defaulted yet, but this is a story that's going to play out in terms of how they restructure and if they can restructure this debt. And the big question is how painful this is going to be for world markets. Here domestically, we've got the Democrats trying to push through a $3.5 trillion spending program. The Republicans are trying to make it smaller and get them to prove that they can fund it. I think largely through higher taxes, mostly on the rich and corporations. And then we have, we're about to bust through our debt ceiling again, William. And the Republicans want to hold them hostage over that. And then there's some other things thrown into the stimulus package to make it political, like desperately needed flood aid to South Louisiana. I was down there a week ago, and it's brutal. So the Dems are trying to tie that to the stimulus package. So in other words, if the Republicans don't buy off on that, they can blame them for doing harm to flood victims. So there's the 2-minute update. William, elaborate on this stuff.
I have nothing to add.
I think not, young man. Oh, but first, the biggest news of the day. I forgot the origin of mankind.
Oh.
Yes, there was a discovery in White Sands National Park in New Mexico. Wesley, can you see the footprints?
Oh yeah, see my ancestors all over.
Yes, you can see your ancestors. And these things are carbon dated back 23,000 years ago. 10,000. They used to think that man was in the Americas around 10,000 years ago, but now they know that it's 23,000 years ago. That kind of looks like your foot right there, Bill.
I think they had
How often do you see Bill's foot?
they had ingrown toenails back then.
They were barefooted. They were barefooted.
That looks like a Croc shoe print to me.
A Croc shoe print.
Yeah. So we've clearly had a lot of negative news. That's been the news for the month of September to date. All the negatives. And there's a saying that markets climb a wall of worry. And we've certainly seen that this month. You know, you've touched on some of them. But, you know, we can go back several months with the COVID Delta variant, and we were seeing a strong rebound in cyclical stocks, things that do best when the economy is growing. The recovery in the cyclicals began really with the low point in the markets in the spring of 2020. So that trough that we had in March of 2020, from that point forward, we saw cyclicals really rallying hard. And then the Delta variant caught the news flow. And so then we started to see a shift away from the cyclicals back into technology names. And so cyclicals have been moving sideways to down. Well, so on top of that, and as you mentioned, the Evergrande Group debt crisis in China, and people are starting to talk about that being a Lehman moment. In fact, there have been so many Google searches of Lehman in the last 2 weeks, but this is not a Lehman moment. But it does concern people because they're concerned about systemic risks and possible contagion coming from this. We'll see. It's really too early to know, but it does appear that China does have this situation under control. There will be bondholders, likely overseas bondholders, that means outside of China, who will take haircuts on their debt. That's just part of it. The Fed certainly took front and center. You know, this week, people wanted to know, will the Fed remain accommodative? Will they turn hawkish? Well, it seems like they're remaining accommodative. Quantitative easing purchases will continue. They have indicated that they may start tightening interest rates, but it will be down the road.
End of next year. They did indicate that they could be tapering as early as November. But
Yeah, we'll see.
I think it's all talk.
It seems like it's all talk. And the federal debt ceiling debate, I think everyone's just tired of this. It's, you know, every year or so, it seems like we have this debate, and it's total brinksmanship, political theater. It makes no matter because it does nothing to rein in congressional spending. I wish they would just do away with it. That's just my opinion. But, you know, the S&P 500 was volatile the last couple of weeks. We saw the S&P 500 breach the 50-day moving average. So people who are more technical in their analysis of the markets got very nervous about that. Yes, it breached the moving average to the downside. We saw the S&P 500 drop 3% intraday earlier this week. But for all of this volatility and hand wringing, the market declined of just a little over 5% from the all-time high. I mean, that's not terrible.
That's
And
using intraday numbers. Is that right?
yes, and then
Yeah.
we're just shy of the all-time high here. Just a little over
Exactly.
2% below it now.
William, the Wall Street Journal uses 65-day moving average, and we breached the 65-day, but we went back. We've gone back above that. We're back above it already today. So
We are seeing rolling corrections, and that is something that strategists are correct to point out. When you look at the index, the S&P 500, for example, it doesn't give the full picture. There are many of components or constituents of that index that have experienced 10% declines or greater in recent months. And the sectors that have done the worst in recent months have been the cyclicals. If you look at the energy components, I mean, all of those, have experienced 10% or more corrections in recent months. But we are seeing the rebound. And since we had the panic day this week, the markets have started moving higher, and it's been the cyclicals leading this recovery. Cyclicals are what's hot right now. But, I think about, some sage wisdom that could be apropos here. And, one of the most famous sayings is from Sir John Templeton: bull markets are born on pessimism, grow on skepticism, mature on optimism, and die on euphoria. Well, we don't have euphoria here, but we do have a lot of skepticism and a lot of fears in the market. There's just a lot that we can look to right now in the environment around us and get concerned about. But what's happening is every time the markets react to a news story, if that fear dissipates, all it does is add fuel to the market, because these markets are discounting this information. By the time you and me hear about it, the markets have already reacted to it. And if it turns out that it's not as bad as everyone thought, then the markets are primed for a rally. And all it takes is a positive surprise, and boom, we're moving up.
I would add a couple of things to that, William. That if we run into stoicism, or just the Republicans having their heels dug in over the debt ceiling and trying to prevent, holding them hostage with the debt ceiling over this $3.5 trillion stimulus package. We have in the past seen some pretty good volatility with, but
it won't happen.
I think that we could see the volatility. I think that
the volatility, but
yes, but in the end, if you think about this, you get all this negative news, you get these seemingly shocking days where intraday the Dow's down 3% or the S&P's down 3%. And, that's a big number. That's about 1,000 points on the Dow. So and then you get the fearful people and the media trying to get more viewers. They exemplify all that stuff. And then you get all the fearful people are out, and then they're gonna approve a new debt ceiling because we have to.
Sure.
We can't do anything. There's government employees that can't be paid.
No one in Washington will allow the U.S. government to default on our obligations. So just see this for what it is. It's kabuki theater. It will create headlines, and we'll get through this, and something will get done to pass the debt ceiling.
And that continues to make the stock market the only game in
Pretty
town,
much.
because the Federal Reserve is met this week. They meet every 6 weeks, the Federal Open Market Committee, and it was a big nothing bag again that the Fed funds rate is going to stay at zero. So who wants to earn zero on their investments?
Not
You know,
me.
we have the stock market.
And when we say the fundamentals, I mean, we're talking about economic market fundamentals. It's questionable whether fundamentals, even matter anymore in this day and age. But it seems like financial conditions, fundamentals, if you want to call that, remain supportive. The Fed is still in the game, that's for sure. With an $8.5 trillion balance sheet, the Fed is driving this train, and the saying "Don't fight the Fed" remains. I mean, as long as the Fed is supporting with their policies, you need to take what they're giving us. But there are some things that we can look to that are positives. Like, for example, the COVID hospitalization death data appears to have peaked. We're not hearing as much about Delta. People are getting out, they're spending money, the economy continues to reopen. The buy the dip, appears to be healthy. And, it's going to remain because there's nowhere else to go until it's no longer valid. But it is still valid. But, if we look at the 4 big economic indicators, employment, industrial production, retail sales, and retail income, they're still in a positive uptrend. So certainly we could have deceleration economically. We could have an exogenous shock. We could have, for example, if something were to blow up in China, who knows? But right now, you still need to be putting your money to work in things that can generate positive real returns.
The focus needs to be long-term, consistent with our watchers' long-term goals, really. Risk tolerance is as long as you're investing in accordance with your long-term goals. Because what happens is these little shakeups that we have can have a tendency to shake somebody
Shake
away
people out of the market
from their long-term investment goals and game plan.
And, it's like, Wesley behind the camera had a great analogy earlier today that he shared. And it's like driving in winter and you hit a patch of ice. It's very easy to overcorrect, but the best course of action is just to take your foot off the gas, maintain control, and keep going in that direction. But we see that with investing is, we hit a patch of ice and people want to overcorrect and they end up in the ditch and they lose all forward momentum.
Well, I was born in Pennsylvania, and I've never come across anybody in Louisiana that knows how to drive on ice.
We don't.
Bill.
We don't. Definitely don't.
I lived in Canada.
No one asked you, Wesley.
If you're going to quote me.
We're going to quote Wesley. So, yeah, I mean, we're not ones, we're not perma bulls. We're not perma bears. We're not perma anything. We want to make money where we can make money, and people can still make money in this market. You just need to know where to put it.
Yes. Yeah. So are you getting to page 2 over here? No?
I can. Did you want to add anything?
No, I was just going to say, William, since to piggyback on your last comment, we actually, whether we thought that we foresaw or we foresaw that inflation was coming, I think that we got that right. We've had portfolios postured to take advantage of inflation. And inflation is defined as a general rise in prices. That is something that long-term, I think, could derail the markets, because what would happen is the Fed would no longer be your friend. And we had this back in the 70s, mid 70s, up until early 80s. The peak, I think, was in March of 1980 with 15% long dated treasury bond yields and 18% mortgages. And then the Fed was behind the curve with Paul Volcker, cigar smoking Paul Volcker, having to increase or raise the Fed funds rate in dramatic fashion to try to thwart inflation. And we're seeing a lot of this. A lot of this can be deemed transitory, but I think that some of it is not. Like for example, we have record low birth rates and an aging population, and really a much smaller percentage of people today in America in the workforce than we've had. And 2/3 of all inflation comes from unit labor cost increases. We've had people that have been making more money, to stay at home. Unfortunately, I had to buy I had a 42-inch refrigerator go out on me, and actually replaced it this morning, but they're not making 42-inch refrigerators right now because of manufacturing issues related to COVID. And I even had a tech come look at it, and there aren't any even evaporator coils available to could have potentially fixed it. I wound up buying a brand new 36-inch refrigerator, which is very common. And those are the ones they're making, not 42-inch. So this is happening all across America, all across the world in manufacturing.
You didn't try to barter for coils on the black market?
Well, I can tell you, I was thorough with this, Bill. I mean, this is we looked all over the place, but unfortunately, we're in a position where we've got a 36-inch refrigerator, and I'm going to have to reframe the space.
Nice. Well, if you don't drive, if you don't pay for housing, if you don't eat, we don't have inflation.
Or if you don't need health care.
Or you don't need health care.
Yeah, think about that. So this is where I was going with that. Thank you. So we have our clients postured to take advantage of things that will do well in an inflationary climate. And we're actually buying some things. We'll just throw this out there to you. We're finding FDIC insured certificates of deposit that could make as much as 10% a year if this plays out like we think with inflation. These were issued 7 or 8 years ago, mostly, and they're called steepeners with a formula that makes the adjustable rate payout of the certificate deposit escalate higher if we have inflation and the long end of the treasury curve goes up. So this is something that we're doing for our clients right now. We do not like the conventional bond market, and that has served us well, really.
And it's not just conventional bonds. It's anything that is interest rate sensitive, because if we do see rising inflation, we would expect to have rising interest rates. And so it's important to understand what you own and how it would expectedly respond to rising interest rates.
And some areas of the stock market are much more interest rate sensitive
That's
than
right.
others, like electric utilities, for example, that are large users of capital, or banks. However, Bill, we could say, especially given what the Federal Reserve has done since 2008 with quantitative easing, that the stock market, generally speaking, is a long duration asset. In other words, it looks like a long dated bond that will not do well if we get into too much inflation.
Well, within the U.S. stock market, it's the technology sector that is most at risk. Okay, so the technology
right.
sector stocks, those are the true long duration assets. And what's been driving the major market indices? Technology. So if you are an indexer, you're just passively investing in, say, the S&P 500 or the NASDAQ 100, just be aware of that. I mean, you are heavily exposed to technology, and that's a sector that would not do well, expectedly, in a rising interest rate environment. We had a couple of questions that were asked of us, and if anyone asks a question, we want to help and do our best to address questions. We had one question. Well, actually, this was a question that was posed to me this morning, and I was talking to this gentleman, and we were discussing the craziness in the markets and zero interest rates, and where do you put money, and that's a question that everyone's been asking. Where do you put money with banks paying nothing, with stock markets at all-time highs? And we've really addressed that to a degree already in this show, and it's something we've talked about in previous episodes. And it's just to kind of reiterate some things here. We do think you can still make money in the stock market, but you have to be selective. You have to know what sectors of the market you need to be in at this point, because we will see rotation out of the previous leadership into the new leadership. But there's certainly money to be made there. As Jack said, we don't like conventional bonds. There are areas of the bond market that make sense, but that they are nichier and they require more work and more understanding, and that's where we can help.
And we're okay if we have a client that is 100% fixed income client. We're very comfortable navigating in these waters right now.
Absolutely.
So, but our bond portfolios are going to look very differently, I think, than most. And but we actually think it is so easy to get in trouble reaching for yield, and there's two ways to do that. You can decrease your credit quality, go for high yield or
junk.
That's also referred to as junk bonds. Excuse me. The spreads between treasuries and junk bonds right now is something like 3.75%, which is a historical low. So if those interest rates go up or we run into problems, economic problems, those bonds could even lose half of their value very easily. And the same is true with a long-dated, high credit quality bond like a 20 or 30-year U.S. Treasury, even a 10-year. 10-year U.S. Treasury bond paying 1.4%. Imagine putting $100,000 in that, and you get $1,450 a year in income, or $725 every 6 months, and then rates go up 1%. Let's say you put $100,000 in that, your investment is now worth roughly $90,000. So,
but I can hold it till maturity and I don't lose a dime. That's what they say. But
that's what they say. They may not lose a dime if they do that, but they're going to lose a lot of sleep along the way.
Sure.
And they won't stay with it either. No.
They'll grow impatient with that.
Yeah.
Another question that we've had, and this is a little technical. but we'll talk about it because it is making financial news, and it has to do with the Federal Reserve Bank's overnight reverse repurchase agreement facility. Okay, that's a mouthful. Okay, we're talking about repos, repurchase agreements. What is a repo? I would explain it this way. It's like going to a pawn shop. You use that if you need immediate money. So let's just say I need some cash. I need some walking around money. So I take my watch to the pawn shop, and the pawn dealer gives me something for it, and then I can go back at a later date and get my watch back, but I'm going to pay interest above what I was given from the pawn dealer. That's basically a repo. Only a repo agreement in the financial world is normally an overnight facility, and that's what this is that the Fed's operating. It's an overnight facility. It's a place. It's used to provide liquidity and take away liquidity. So reverse repo is the opposite. So what's going on here is there's so much liquidity, so much money sloshing around in the system. Okay, we're talking about years of Federal Reserve quantitative easing, and there's a lot of cash built up in money market funds. Banks have way too much cash. They're not lending money. Demand for loans is down. And so this money has to go somewhere. Well, the Treasury has been able to absorb a lot of that by issuing debt. So the Treasury issues debt, and then banks will buy this debt, and then the Federal Reserve buys these treasuries. So you see where we're going with this. But what's going on is that there's all this liquidity with no place to go. The Fed has this reverse repo facility. So what they are doing is they are selling Treasury securities to banks and money market funds. In return, they're taking cash from these institutions and these funds. It's an overnight facility. I think a lot of this is seasonal. And yeah, it is a little troublesome when you see the demand for this facility went from 0 to 1.4 trillion in a matter of months. And the Fed just doubled the amount of cash that they're willing to take from an individual counterparty from 80 to 160 billion. But, when we get through the debt limit debate, then you'll see the Treasury issuing lots and lots of T-bills. And I think with the new T-bill issuance, that will resolve a lot of this, and it will just go away. But it's really kind of a technical matter. But people are using it to alarm the public.
So we've answered our questions then, the two questions that we had. Yeah.
Unless we've got some fresh ones back there that we don't know about.
Well, we've got,
No.
it's sporting news time, and we've got NFL and college football kicking off. We have the Ryder Cup, which began this morning. They're playing in Wisconsin this year, Whistling Straits. They say that sets up better for the Euros. I think they've actually beaten us 12 of the last 15 years, Bill. And that was actually in today's sports section of the Wall Street Journal, which is rather embarrassing when you look at how good our golfers are. Europe has won 9 of the past 12 Ryder Cups dating back to the 1990s. But the USA, I don't know how they did this afternoon, but USA had a 3-1 lead this morning. We've also got the Saints at New England, and I happened to be at the Saints game with my bride last weekend in Charlotte. The Saints will be playing their first home game in the Superdome, which was flooded out the following Sunday. But, the Saints blew out the Green Bay Packers 38-3 in game 1. And then they lose to Carolina, who's now 3-0 with their victory last night over Houston. But the big question is, Bill, which Jameis Winston is going to show up? He looked like one of the worst quarterbacks ever.
I say
in
buy
Charlotte.
the dip.
Huh?
Buy
You
the
say,
dip.
I say buy the dip too.
Saints will recover all
Yes.
demise.
I think so too.
What's your favorite dip?
And then we've got, I like Andouille the best. We've got LSU. Is LSU at home or at Mississippi State?
I don't know. Actually.
Same difference.
Well, LSU's playing Mississippi State. They were surprisingly beaten up on last year. Remember? In fact, Mississippi State set an SEC record with 630 yards passing. And Ed Ogeron is going to be on the hot seat if we don't beat teams like Mississippi State and Arkansas that look like they're going to be. Mississippi State happens to be undefeated, and this will be a very tough game. Should be a very close game, and I sure hope the Tigers get the nod on this one. So that's a wrap on sports.
Yeah, Wesley just said he sure hopes we wrap this up soon.
I didn't say anything. Putting words in my mouth.
Okay, we will see you. We may see you next Friday from afar,
Or maybe not.
Probably.
or maybe not.
Probably not.
We could do something brief, perhaps.
Or not at all.
But we'll be back live soon. Thank you for watching, and let us know if you have any questions or comments. Stay safe, enjoy this cool fall weather, and make good decisions.